buy bonds that have a negative yield. And it's crazy, isn't it? It is crazy because you're lending to the government and you're paying the government to lend to the government. You all know that the last institution I would lend to at the moment would be a government, especially issued 100-year bonds, the Austrian government. When yields drop, the price of those longer dated bonds or longer duration bonds, they go up very fast. They go parabolic. So it became like a speculative mania, not a place for bond fund managers really to manage a fixed income portfolio. But experts dismissed this talk of a bond bubble back in 2019, and the excuse was demographics and excess savings. And I give an example here at the presentation at the conference of all these experts here. One is from JP Morgan, the other one was from BlackRock, the other one's from Vanguard, and the other one from PIMCO, all in 2019 when we had $17 trillion of negative yielding government bonds. They said, no, we're not in a bubble. But we went as high as almost 5% in 2022. We've been consolidating ever since, but we're going to look at what's going on right now. And this is the important part for those of you who might be concerned about what's going on with gold today, is that since that low in the 10-year yield at one, well, not low, but the breakout and the beginning of a bear market in bonds, gold is more than double, because gold actually touched that level around 1650, which was Jim Sinclair's objective at one point on the upside. It actually acted as a major support. And yes, the gold price did come down that year, mainly because bond yields started going higher. And I think most people thought, well, a lot of investors thought, well, that's negative gold. And they tell you why in a minute. We've got the Dow, that's down about 500 points. S&P is down about 100. And the NASDAQ 100 future is down about 540 points. Why am I not concerned? Well, because the bond bear market is getting even worse, and it's not just in the UK, it's in the US as well. As I speak here, the 10-year...
What you just heard should stop every investor in their tracks. The sheer scale of negative yielding government bonds is a financial anomaly, a symptom of a system in distress. Legendary investor Ray Dalio has repeatedly warned about the dangers of central banks recklessly printing money, creating what many now call the biggest bubble in human history. With $17 trillion in negative yielding government bonds, the market is screaming that something is fundamentally broken, and it's not just a minor correction. This unprecedented situation makes the case for gold and silver as financial insurance more urgent than ever, especially when traditional safe havens like bonds offer no real return. As for me, I did buy a little bit of gold the other day, and I always try to do that with gold and silver, having seen these market cycles since I started buying in '02. But what our next speaker reveals changes the entire picture, showing why this isn't just about preserving wealth, but about navigating seismic institutional shifts.
Just in the UK, it's in the US as well. As I speak here, the 10-year Treasury yield is up 12 basis points, which is huge. Believe me, it's a big move. I worked in the bond market for 20 years, and I can tell you that 12 basis points is not normal. There's a problem, and it's at 460 or 458. The 30-year is gone above 510. It's up 10 basis points. And in the UK, it's even worse. We've got the 10-year yield up almost 20 basis points at 517. The 30-year is at 585, up 20 basis points. And even the German government bond yield curve is rising. And the Germans have always been more careful with their finances, even though in the last few years that's gone out the window. But for example, the 10-year Bund yield is up 10 basis points today, and it's broken up broken through 3%. It's at 3.15. So this is a worldwide sovereign debt problem, and I think it's going to get worse. And the central bankers are going to have to step in. It's only a matter of time before things go really bad. And there was a very interesting speaker later on this afternoon. His name was Michael Howe, and he's like an expert in liquidity. I'm going to try to find his website and his link. I'm going to put it below in the description. English guy, and he spoke about this, that nowadays most of the liquidity is created through the repo market, the collateral market. And what's used for collateral? Well, government bonds. And the problem is, if government bond prices go down, collateral goes down. And if we're in a bond bear market, we're not in that bull market from 1980 to 2020. Yes, where I do agree, when yields went up during that bull market, counter trend, let's say corrections, it did hurt gold. But now the central bankers are, they're way behind the curve. Central bankers are, they're way behind the curve, and they're not going to be able to raise rates to defend their currencies against higher prices. We see that money supply and liquidity is still going through the roof. So I always think of what the alternative is when we have days like this. And we've been having days like this in gold and silver since I first started buying gold and silver in 2002. And it's always, well, in the beginning it was scary, but now I'm used to it. But the question I always ask when this happens is, what is the alternative? Do I really want to get rid of my precious sound money, gold and silver, turn it into a debt-based instrument that is losing value hand over fist, and put it in an institute? I did buy a little bit of gold the other day, and yes, if I do get spare fiat currency, I always try to do that, gold and silver. So yes, as I said, I'm speaking on Friday. It's around 3 p.m. London time. I'm in Frankfurt, and it's 4 p.m. There's going to be another speaker, I think around 5:30, Mark Friedrich. He's a German. Interesting guy. I'm going to listen to that. And I've been invited for a dinner later on tonight. I've been invited for a dinner tomorrow, and that's why I'm staying here till Sunday. But you'll be listening to this video on Saturday. And yeah, I'd just like to thank all of you as well for the support that you've given my channel. If it wasn't...
We just heard about a worldwide sovereign debt problem, a bond bear market where central banks are way behind the curve. This isn't just academic talk, it's a direct threat to your savings, your retirement, and the stability of the entire financial system. Think about it. $17 trillion in negative yielding government bonds just a few years ago. Who buys that? What happens when the buyer of last resort stops showing up? We're witnessing the biggest bubble in human history, and it's not just stocks, it's the bond market too. These are the very assets that are supposed to be safe, the bedrock of financial insurance. But when governments recklessly print money, those bonds become a ticking time bomb. The smart money, the real money, understands this. They're not waiting for the postmortem on a structure that is already failing. They're moving into physical, gold and silver, the ultimate refuge. They know that when the music stops, you want to be holding something real, something tangible, something that can't be conjured out of thin air by irresponsible governments. So the real question is, do you want to be the person who understood this early, or the one who explains it to their accountant later?